Malkiel's central thesis is that stock prices are largely unpredictable, and that attempts to outsmart the market by picking individual stocks or timing the market are likely to fail. Instead, he advocates for a passive investment strategy, such as investing in a broad-based index fund, which will track the overall performance of the stock market. Malkiel's arguments are based on the efficient market hypothesis, EMH, which states that all available information about a stock is already reflected in its price. This means that there is no way to consistently beat the market by using technical analysis, fundamental analysis, or other investment strategies. A Random Walk Down Wall Street has been both praised and criticized for its iconoclastic viewpoint. Some critics argue that Malkiel underestimates the ability of skilled investors to beat the market, while others believe that his arguments are overly simplistic. However, the book has been influential in shifting the investment world away from a focus on active management and towards passive investing. Here are some of the key points from A Random Walk Down Wall Street. Stock prices are random. This means that they cannot be predicted with any accuracy and that past performance is not a reliable indicator of future performance. Active investors can't beat the market. This is because all available information about a stock is already reflected in its price. Any attempt to use this information to make an informed investment decision is essentially futile. Passive investing is the best strategy for most investors. This is because passive investments, such as index funds, are designed to track the overall performance of the market. This means that they will provide investors with a low-cost, diversified way to invest in the stock market. A Random Walk Down Wall Street is a must-read for anyone who is interested in learning more about investing. The book is clear, concise, and easy to understand, even for those who have no prior experience with investing. Malkiel's arguments are well supported by data, and he provides a balanced and objective view of the investment world. Part 1. The stock market, a jungle or a classroom? Chapter 1. What is the stock market? In this chapter, Malkiel defines the stock market as a place where individuals can buy and sell shares. Shares represent ownership in a company, and investors buy shares with the hope that the company's value will increase, consequently raising the value of their shares as well. Key points. The stock market is a global market, with participants from around the world. The stock market is an active market, with millions of transactions taking place every day. The stock market is a complex market, with numerous variables that can impact stock prices. Chapter 2. How does the stock market work? In this chapter, Malkiel explains how the stock market operates. The stock market is regulated by the Securities and Exchange Commission, SEC, which is tasked with protecting investors and ensuring market fairness. Key points. The stock market operates through the forces of supply and demand. Stock prices are based on investors' expectations regarding the future of the company. The stock market is subject to speculation, which involves buying or selling stocks with the hope of achieving quick profits. Chapter 3. Why is the stock market so volatile? In this chapter, Malkiel explains why the stock market is so volatile. Volatility is the measure of the variation in stock prices. The stock market is volatile because it is subject to a range of factors, such as economic conditions, political events, and rumors. Key points. Stock market volatility is an inherent characteristic of the market. Volatility can present opportunities for investors, but it can also pose a source of risk. Investors should be prepared for stock market volatility. In general, the chapters in the first part of A Random Walk Down Wall Street provide an overview of the stock market. Malkiel explains how the market operates, the factors that can influence stock prices, and market volatility. These chapters serve as a solid foundation for anyone interested in learning more about investing. Part 2. Can the individual investor beat the market? Chapter 4. What do the data say? In this chapter, Malkiel examines data on the performance of individual investors and actively managed mutual funds. His findings show that, overall, individual investors cannot outperform the market, and actively managed mutual funds, which charge higher fees than index funds, underperform the index they aim to track. Key points. Individual investors do not have an advantage over professionals. Individual investors often make mistakes that hinder their ability to outperform the market. Fees from actively managed mutual funds can significantly reduce investors' returns. Chapter 5. Can individual investors beat the market? In this chapter, Malkiel examines the strategies that individual investors can employ to try to outperform the market. His findings show that, while some strategies may work in the short term, no strategy has proven to consistently beat the market over the long term. Key points. Active investment strategies are challenging to successfully implement. Active investment strategies require a significant amount of time and effort. Active investment strategies can be costly. Chapter 6. Can active mutual funds beat the market? In this chapter, Malkiel examines the performance of active mutual funds. His findings show that, overall, active mutual funds underperform the index they aim to track. This is due to the fact that active mutual funds charge fees, which reduce investors' returns. Key points. Fees from active mutual funds can significantly reduce investors' returns. Active mutual funds can be costly. Selecting active mutual funds can be challenging. In general, the chapters in the second part of A Random Walk Down Wall Street provide evidence supporting Malkiel's thesis that individual investors and active mutual funds cannot consistently outperform the market over the long term. Chapter 7. What is passive investing? In this chapter, Malkiel defines passive investing as an investment strategy that seeks to replicate the performance of a stock market index. Index funds are a form of passive investment. Key points. Passive investing is a simple and easy-to-implement strategy. Passive investing is a low-cost strategy. Passive investing is a strategy that has proven to be successful over the long term. Chapter 8. What are index funds? In this chapter, Malkiel explains how index funds work. Index funds are mutual funds that track a stock market index. For example, an S&P 500 index fund will mirror the performance of the S&P 500 index. Key points. Index funds are a form of passive investment. Index funds are low cost. Index funds provide a diversified way to invest in the stock market. Chapter 9. How to choose an index fund. In this chapter, Malkiel provides advice on how to choose an index fund. Malkiel recommends selecting an index fund that tracks a broad index, such as the S&P 500 or the Russell 3000. He also suggests choosing an index fund with low fees. Key points. Choose an index fund that tracks a broad index. Choose an index fund with low fees. Compare index funds before making a selection. Overall, the chapters in the third part of A Random Walk Down Wall Street provide an overview of passive investing and index funds. Malkiel argues that passive investing is the best strategy for most investors as it is simple, low cost, and has proven to be successful over the long term. Part 4. How to invest successfully. Chapter 10. How to invest for the long term. In this chapter, Malkiel explains the importance of investing for the long term. Malkiel argues that investors who invest for the long term are more likely to succeed than those who try to achieve quick profits. Key points. Invest for the long term. Avoid attempting to make quick profits. Be prepared for market volatility. Chapter 11. How to avoid mistakes. In this chapter, Malkiel identifies some of the most common mistakes made by investors. Malkiel recommends avoiding these mistakes to increase the chances of success in investing. Key points. Don't try to outperform the market. Don't follow others' advice blindly. Don't invest with money you can't afford to lose. Chapter 12. How to diversify your portfolio. In this chapter, Malkiel explains the importance of diversifying your portfolio. Malkiel argues that diversification reduces the risk of your investment. Key points. Diversify your portfolio. Invest in different asset classes. Invest in different sectors. Chapter 13. How to choose a financial advisor. In this chapter, Malkiel provides advice on how to choose a financial advisor. Malkiel recommends selecting a financial advisor who is independent and has experience in passive investments. Key points. Choose an independent financial advisor. Select a financial advisor with experience in passive investments. Compare financial advisors before making a decision. Chapter 14. How to invest overseas. In this chapter, Malkiel explains how to invest overseas. Malkiel argues that investing abroad can help investors diversify their portfolio and reduce risk. Key points. Consider investing overseas. Invest in both developed and emerging countries. Diversify across different asset classes. Overall, the chapters in the fourth part of A Random Walk Down Wall Street provide practical advice for investors. Malkiel offers guidance on investing for the long term, avoiding mistakes, diversifying your portfolio, and choosing a financial advisor. In conclusion, A Random Walk Down Wall Street is a fascinating and educational book about the world of investing. The book provides a balanced and objective view of investment strategies, advice for investors, and common mistakes that should be avoided. If you are interested in investing, this book is a must-read. Thank you for joining this exploration of A Random Walk Down Wall Street. Remember, knowledge is the first step towards change. Now, I invite you to share in the comments which lesson impacted you the most. Don't forget to subscribe for more content on financial education and personal development. Together, we'll build a path to financial freedom. See you in the next video.